Welcome to the Deep Dive. We cut through the noise of earnings calls and reports to bring you the insights that, well, really matter.
We try our best.
Today, we're digging into Unibail Rodamco Westfield, URW. Their H1 2025 results just dropped.
Yep, and there's quite a bit to unpack here. We're looking at how this huge commercial real estate player is handling things.
Exactly. The mission today is to figure out what these numbers tell us about their strategy. Is this turnaround story we've heard about actually happening?
Well, that's the big question, isn't it? And these results, I think, they do paint a pretty compelling picture. You know, they've been so focused on fixing the balance sheet for years.
Repair phase, they called it.
Right. But now we're seeing signs they're not just stabilizing. It looks like they're actually setting up for some, let's say, measured growth. It feels like a real pivot.
Okay, a strategic pivot. That sounds significant. Let's get right into those headline numbers then, because they definitely made some waves.
It did.
URW reported non-GAAP adjusted recurring earnings per share, AREPS, of 5.11 for the first half. That beat the consensus of 4.92. Quite a beat, actually, almost 4%.
Yeah, nearly 4%. My first thought, it signals maybe more resilience than people expected, especially given, you know, the wider economy.
Right. Beating by that much isn't just noise.
No, it suggests their operations, their flagship assets, they're really delivering value, maybe even better than the market thought in some spots. Speaks to the quality, I think.
Okay, quality assets. Let's look under the hood at what drives AREPS. Net rental income, NRI, was $1,175 million. Now that's down slightly year over year, 1.3%.
But, and this is the important bit, the like-for-like NRI was up 3.6%.
Ah, the like-for-like, crucial distinction, right?
Absolutely crucial. It filters out the noise from assets they've sold or bought. So it shows you how the core existing portfolio is doing.
So 3.6% growth there, plus like-for-like EBITDA was up 4.1%.
Exactly. Strong core performance. It tells you the assets they kept are working well, even while they're slimming down the portfolio overall, especially the shopping centers.
Yes, let's focus there. Shopping center NRI specifically jumped 4.1% like-for-like. How? Well, 1.6% more footfall, and tenant sales surged 3.8%.
And critically, those numbers beat the national sales figures and inflation.
So what does that tell you? Getting more people in and getting them to spend more, beating the averages.
It tells me they've got pricing power, desirable locations, prime assets. It's that flight to quality we keep hearing about. Consumers and tenants are focusing on the best spots.
And URW has those spots.
Seems like it. When you outperform the benchmarks like that, it really says something about the dominance of your centers.
And that flight to quality shows up in vacancy too. It dropped 60 basis points year over year, down to 4.9%.
Yeah, 4.9%. That's not just good. It signals real commercial tension is back. Tenants want these spaces.
Which gives URW leverage.
Exactly. More leverage in negotiations. Hints at future rent growth. Low vacancy means they can pick and choose, push rents higher.
Okay, strong operations. Let's pivot to the balance sheet. They made progress there too.
Yeah.
IFRS, loan-to-value, LTV, down 80 basis points to 44.7%.
Including the hybrids, yeah. And net debt to EBITDA improved too, from 9.5 times down to 9.2.
So for our listeners, what's the bottom line on these balance sheet numbers?
The bottom line is less risk, tangibly less financial risk. Lower LTV, lower debt to EBITDA, those are key solvency metrics. It means more flexibility, lower interest costs, looks better to lenders, investors. It just strengthens the whole foundation.
And a really interesting point, the portfolio valuation. The whole thing was up 1.2%. But the kicker, the U.S. portfolio saw a positive revaluation. Only 0.4%, but positive.
Yeah.
First time since the Westfield deal.
Yes. This is, I think, maybe one of the most important signals here, even if it looks small. The U.S. assets, especially Westfield, they've been dragging down valuations for years.
Right, a constant headwind.
So even a tiny positive number suggests yields are stabilizing, and maybe, just maybe, that rental growth is finally starting to push up the actual asset values on the books. It challenges that old narrative, could be a re-rating trigger.
A potential turning point for how the market sees those assets. And underpinning all this, the disposal program. They're on track. $1.6 billion done or secured, aiming for $2.2 billion by early 2026.
Shows discipline, focus. They're selling assets to cut debt, optimize the portfolio, and really concentrate on those top-tier flagships. Hitting these targets builds confidence.
Okay, and finally, the outlook. Management sounds pretty upbeat. They guided full-year AREPS to the upper end of the range, 9.30 to 9.50.
And proposed a higher distribution, $4.55 per share for FY25. That's up around 30% from 2024.
A 30% jump in the distribution. That signals serious confidence.
It absolutely does. You don't promise that unless you believe the cash flow is strong and growing. It's part of a bigger commitment, too. $3.1 billion in distributions by 2028. That's moving way beyond just repair. That's value creation talk.
Okay, let's dig a bit deeper into some of those operational wins. Tenant sales Europe up 3.1%, solid, but the U.S. up 5.7%. That's really strong.
Very strong. And remember, that's consistently beating inflation and the national sales figures.
What does that mean for rents going forward if tenants are doing that well?
It means they can afford higher rents. It creates this positive loop, right? Profitable tenants are happier to sign longer leases, accept rent increases. That feeds directly into URW's rental income, especially with those strong U.S. numbers.
Which brings us back to vacancy. Group at 4.9%, lowest since the deal. Europe even tighter, 3.6%. U.S. flagships at 6.3%.
That 3.6% in Europe is incredibly low. It just shows how tight the market is for prime retail space there. Not much new supply being built.
Makes existing centers more valuable.
Exactly. And 6.3% in the U.S. flagships is still really healthy. It shows demand is strong there, too. Gives URW a very strong negotiating position.
And you see that position in the leasing numbers. $202 million in minimum guaranteed rent signed in H1. But the uplifts, wow.
Yeah, the uplifts were pretty eye-watering.
7.1% uplift on new leases on top of indexation. And for long-term deals, which were 80% of the activity, the uplift was 11.6%.
11.6%. Before indexation, that's like 13.1%. Really strong.
But the U.S. long-term deals, 27.6% uplift, 27.6%. That's massive. What on earth is driving that?
That's the flight to quality and flashing neon lights. It's phenomenal. It tells you that for retailers wanting to connect with consumers, these absolute prime flagship locations are non-negotiable. They have to be there.
So they're willing to pay up significantly for that certainty.
Precisely. After years of maybe holding back, they're committing to the best spots because they see the sales performance. It's pent-up demand hitting very limited prime supply. And that 27.6%, that flows straight to the bottom line and boosts asset values.
And crucially, occupancy cost ratios, OCRs, stayed stable, so tenants can seemingly afford these higher rents.
Stable OCR is key. It means rents are rising, but not so fast that it's crippling the tenant's business within the center. It suggests there's still room for more rent growth, what they call reversionary potential.
Meaning they could probably push rents higher on renewals where old leases were below current market rates.
That's the idea. And it's backed up by fewer bankruptcies impacting them only 86 units. And they re-leased or kept most of those anyway. Shows tenant health in their own releasing skill.
Okay, let's switch back to the deleveraging strategy. $1.6 billion done, another $0.9 billion under discussion. Some big deals in there, too.
Yeah, selling stakes in Forum Les Halles, Trinity Tower, selling the Pullman Montparnasse Hotel for over $300 million, even the airport's business.
That hotel deal was the first big one in Paris since 2019, right?
It was. Shows they can execute big, complex deals. They're clearly focused, selling non-core stuff, offices, hotels, smaller retail, the airport unit, to simplify and focus purely on those core flagship shopping centers. It's very methodical.
And the refinancing wins were impressive, too. That $1.2 billion CMBS deal, saving 190 basis points.
Yeah, and the Century City part of that got incredible terms. Tightest spread since 2019. Tightest coupon for a single asset CMBS in 5 years.
What does that signal specifically, that level of detail?
It's a huge market endorsement. It means lenders see those specific assets, Century City, Roseville, as extremely high quality, low risk, rock solid cash flow generators. Securing debt that cheaply directly cuts interest costs, boosts earnings, smart financial engineering.
Plus they rejig some hybrid notes, saving another $7 million there.
Every little bit helps. It all adds up to a stronger financial position.
Okay, circling back to valuations. Overall portfolio up 1.2%, Europe up 1.4%, US up 0.4%. Net initial yields now 5.4% in Europe, 5.1% in US flagships. What's the bigger picture implication of this stabilization?
The bigger picture is a potential re-rating of the stock. If the market finally believes the asset values aren't falling anymore and might actually be rising, that discount the stock has traded at could shrink. It suggests the worst might be over for valuations.
So not just fixing the balance sheet, but also looking for new growth avenues. Westfield Hamburg Übersee Cartier launched in April. Sounds like success.
Huge success, apparently. Nearly 4 million visits already, retailers beating targets, handed over office space to Shell. It proves they can still deliver these massive, complex, mixed-use projects successfully.
It's a template for the future, maybe.
Could be. Shows their development muscle is still there.
And then there's the brand licensing deal in Saudi Arabia with Sinoni Centers, licensing the Westfield brand for potentially 8 centers.
Yeah, this is interesting. Targeting €25, 35 million in EBITDA by 2028 from this. It's asset light. Meaning they don't have to spend billions building these centers themselves. They leverage the power of the Westfield brand, which is globally known to collect fees. High margin, low capital involved. It's monetizing their brand equity in a growing market without taking on huge development risk. Very smart.
Plus, Westfield Rise, the retail media agency, expanded to the U.S., already hit 60% of its budget for the year, $40 million net income in H1. Another diversified stream.
Yep, adds to the mix. And notice the development pipeline is shrinking, down from $3.5 billion to $1.9 billion, heading towards $1.1 billion by year-end.
Why is a shrinking pipeline good here?
Because it means they've delivered the big projects. Capital commitments are coming down. That frees up cash for debt reduction, distributions, other things. Fits that measured growth narrative, moving away from heavy capital spending. More cash generative.
So, wrapping up the outlook. Guiding AREPS to the top end for 2025, bumping the distribution, reaffirming 2026 guidance even with FX risks, and expecting vacancy to drop further.
It screams confidence. Management clearly believes the plan is working, operations are strong, and they can deliver consistent, growing returns. The message is, deleveraging is happening, performance is robust.
Okay, so what does this all mean if you're watching URW? Clearly, that strategic narrative shift is real, from repair to measured growth with deleveraging.
And it's backed by the numbers, debt reduction, disposals happening, strong operations, less risk.
The market reaction was, okay, up 0.64% on the day, but it had been higher.
Maybe a bit muted. But you have to remember, the stock's already had a massive run-up, over 34% in the past year, way ahead of the CAC 40 or the European Real Estate Index. So maybe some of the good news was already baked in.
Fair point. But that positive revaluation, especially the U.S. turning positive, that still feels like a key signal. And the new revenue streams like licensing.
Absolutely. Things to watch going forward. Keep an eye on continued disposal progress, that leasing momentum, especially if those huge U.S. uplifts continue, and how Westfield Hamburg and the Saudi deal progress. Q3 update on October 23rd will be the next checkpoint.
All right, let's shift gears. Time for our not financial advice segment. Thinking about this URW story, that U.S. valuation uptick, first time since the Westfield deal. I still feel the market might be underappreciating just how significant that is.
Yeah.
It feels like more than just a data point.
It could be a genuine turning point. So if you buy that premise, here's an outrageous but plausible trade idea. Again, not financial advice.
Lay it on us.
Consider a pair trade. Long URW, short U.S. regional mall REITs.
Okay, interesting. Long URW, short the smaller U.S. players. What's the logic?
The logic is that flight to quality we talked about. URW's flagships are showing real strength, those massive rental uplifts, like 27.6% in the U.S., actual positive revaluations. They have pricing power.
While many smaller regional malls.
Well, even if the tide is lifting all boats somewhat, many regional malls just don't have that same dominance, the same ability to command top rents, or the same access to capital to reinvest and keep the assets top tier. This trade is basically betting on that quality gap widening.
Arbitraging asset quality and execution.
Exactly. Plus, URW's deleveraging gives you a bit of a safety net on the downside, while things like the brand licensing offer upside potential that most regional mall REITs just don't have. It's a bet on structural divergence within retail real estate.
A bet that the best are pulling further away from the rest. Makes sense. Okay, let's wrap this up.
Sounds good.
Unibail Rodamco Westfield's H1 2025. It really shows the company hitting its stride on that platform for growth strategy, strong earnings beat, solid operations, real progress, cutting debt through disposals, smart refinancing. It all points to fundamental strength and lower risk.
Yeah, and that positive portfolio revaluation, especially the U.S. turning the corner, that's a big psychological and financial positive. Plus, the new ventures like Hamburg and the licensing deal show they're thinking about future income streams. Raising guidance, boosting the dividend, it all signals strong confidence ahead.
Definitely a compelling story unfolding. Just a reminder to everyone listening, this discussion is for informational purposes only. It's absolutely not financial advice.
Please always do your own homework, your own thorough research, and talk to a qualified financial professional before making any investment decisions.
We'd love to hear your thoughts too. Engage with us. Share your insights. Let us know what earnings calls or reports you want us to tackle next time on The Deep Dive.